Welcome to another episode of The Brand Called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from thousands of successful individuals from around the world. I'm your host, Ashutosh Garg, and today I'm delighted to welcome a very senior and respected professional from the world of finance and fintech, who's also an author from Toronto, Canada, Paul Musson. Paul, welcome to the show.
Thank you, Ashutosh. It's great to be here.
Thank you. Paul is the president of Paddington Capital Management Incorporated. He's an author, and all of you know I'm very partial to authors. He's an author of a book titled Capital Offence: Why Some Benefit at Your Expense. So, Paul, before we start talking about your book and Paddington Capital, a few questions for you. Tell me about your journey. After such a long tenure in institutional investing, what inspired you to start your own firm?
Well, I loved my career, most of which was at Mackenzie Investments here in Toronto.
Mhm.
And it was investing in high quality companies around the world. And so I really enjoyed that meeting with world-class businesses, world-class people,
Mhm.
understanding how a business thrives over time.
Yeah.
And it really is about creating a true customer value
Yeah.
proposition.
Mhm.
There's a there's a saying in economics where the consumer is sovereign.
Mhm.
Like the consumer is under no obligation to buy whatever it is you are offering.
Mhm.
They're only going to do so if they value it. And so you see companies creating real capital, taking our client savings and investing those savings, that capital, to create more capital.
Yeah.
And then the world is better off. Customers are better off. The companies hire more employees. They get paid more. Everybody wins.
Mm.
And so I was communicating this to my clients over the years, and I focused very much on clear communication.
Mhm.
And it's like an intellectually honest approach. And even if I believed that the client might not like what they were going to hear, I would tell them because they deserve to know the truth. And
Right.
because the people are smart, they
Right.
need to have all the facts and they're smart enough to make their own decisions. They don't need me making their decisions for them.
Mm.
And so clear communication. And then I started witnessing how central banks were distorting the system for
Mhm.
short-term gain, all with good intentions, but with very bad long-term outcomes.
Mhm.
And I was clearly explaining this to my clients. And then over the years, a number of clients, and including a couple of my bosses, said, Paul, you should write a book about this one day.
Mhm.
And so I started writing the book in 2019.
Mm.
And and I found that over the years, writing was becoming my true passion.
Mm.
And it was becoming my passion. I just enjoy it, but helping people,
Mm.
empowering people, um, really, it really drives me. Like it really gets me up in the morning, and
Mm.
and it was harder to do that being an investor. You could still do it, but it's easier to do it. You could be more effective by being a writer.
Mm.
And so I loved my job. I loved my company. But it was just time to, and I sort of had the succession plan in place for a number of years. The team was ready to go without me. And it's like if you have a successful succession plan, you succession yourself out of a job,
Absolutely.
And they're doing a great job. They're doing really well.
Mm. Amazing.
And yeah, and so then I started my company, Paddington Capital Management. So it's an investment consulting.
Mm.
And I consult with my former
That's
employer,
fascinating.
and I have a blog as well.
Fascinating. But was there a specific moment or realization that pushed you to speak out more publicly through your blog and now your book about the structural flaws in our economic system?
I don't know if there was a single eureka moment.
Hmm.
I think it was just things sorry, had evolved over time. And yeah, it's not something. like for me, I don't, I'm not a very impulsive person. I'm a
Hmm.
very cautious person,
Yeah.
careful, worrywart.
Yeah.
And so I do things slowly and I build an infrastructure, a foundation, and make sure this is the right thing.
Mm.
And then I finally, I don't even do a leap. I do a small step,
Mm.
and
Mm.
so I think it was more of a slow evolution and then got me to that point. Yes, it was a result of a number of years.
Absolutely. So now
Mhm.
let's talk about your book, Capital Offence, Why Some Benefit at Your Expense. Um, my first question is that the title is quite provocative.
It is.
What is the deeper meaning behind it? And who did you
Okay.
have in mind as your core audience?
So, the a number of publishers asked me this when I was trying to get it published, and I struggled with that question because I really do believe that just about anybody would benefit from reading this book.
Yeah.
So I think it transcends generations, cultures, um, and or income, and but those who I think would benefit the most would be the younger generation, and we will get into that soon because they're the most harmed
Yeah.
by our current monetary system.
Mm.
And the reason for the title is that a lot of people um, don't differentiate, either are not able or refuse to differentiate between capital and money.
Mm.
So, very quickly, the difference is if the example I use in my book throughout my book is bikes. So, let's say, Ashutosh, you make bikes. And so you create a bike, you build a bike, you've created capital.
Mhm.
Now, that bike, that capital now gives you the wherewithal to go out in the economy and and exchange your bike for somebody else's capital. So maybe I made a suit. So you come to me, so I made a bike.
Mm.
I like your suit. Okay, here's my bike for your suit.
Mm.
We both created capital, right? There was no bike and suit in the economy.
Mm.
We both created capital, and it didn't come at the expense of anybody else, right? And that's very important. And that's the way a free market system is supposed to work.
Mhm.
Let it's functioning less like that now, and we'll talk about exactly
Yeah.
how that works.
Mm.
And so, but we don't have it's not a barter system, a direct exchange.
Mm.
Rather than give me your bike for my suit, you first sell your bike. Let's say you sell it for $1,000,
Mhm.
and then you use that $1,000 to buy the suit. Now, let's say you make 10 bikes and you sell them for $10,000. You don't spend the money right away because you're saving up that money because you're going to buy something at the end of the year.
Mm.
Now, that $10,000 in your bank account effectively is storing your 10 bikes. It contains 10 bikes of capital.
Right.
Right? That's what you have in that money.
Mhm.
But if before you get a chance to spend that $10,000, the central bank doubles the money supply,
Mhm.
when they create money out of thin air,
Yeah.
they did not create any capital to get that money.
Yeah.
That new money has no capital stored up in it.
Mhm.
It only obtains capital by going into circulation and extracting capital from the rest of the money already in circulation.
Yeah.
So when they double the money supply, it takes five of the bikes that's in your $10,000 and puts it into the newly printed money.
Mhm.
And so you still have $10,000 in your bank account. So you think, oh, that's good. But your $10,000 now only stores five bikes instead of 10. So
Right.
now that $10,000 will only buy half as much as it would have done before the central bank doubled the money supply.
Right.
It took your capital without your permission. And that's why the name of the book is Capital Offence.
Well said. Well said.
Right.
Great response. You
Thank
also
you.
mentioned that well-meaning policymakers have fallen for something from nothing Kool-Aid. Could you explain this idea and how it shapes policy decisions today?
Yeah, so policymakers believe, not all of them, but they believe that you can get something for nothing, that you can. print money, that you can artificially drive asset prices higher,
Mm.
which benefits some, and that it doesn't come at the expense of somebody else.
Right.
Unless it's a mutual benefit situation,
Mhm.
then if you obtain something without giving something back, it has to come at somebody else's expense.
Yeah.
But through the printing press or inflation or deficits or debt, you can't see who that person is who's getting screwed. And so it's very easy to believe that what you're doing doesn't have any consequences. So you can just sort of turn a blind eye to it because the immediate effects of your actions are stock prices going higher or housing prices going higher or people spending more money that eventually results in inflation.
Mm.
And so it's almost like a disease of first order effect thinking. I do this action and here's the response.
Right.
But what's really important is that you need to think of second and third order effects of your actions, not just from an economic perspective, but in your own life, your own personal life, we have to do that.
Yeah.
And Thomas Sowell was a famous economist, said that in economics, there are no solutions. There are only trade-offs.
Mm.
And so if you think in that way, I think you make better and more responsible decisions because you consider more of the potential consequences of your actions. But a lot of people don't want to think about the potential consequences. They just want to think about the benefits.
Mm. Great response. You also
Yeah,
highlight that we are benefiting at the expense of future generations. What does that look like in practical terms for an average family today?
sure. So the, I mean, it happens in a couple of ways, but the easiest way to understand it, and it's particularly so here in Canada
Hmm.
and in Australia, and increasingly so in the US. So I'll just back up a second.
Hmm.
So if stock prices are rising,
Going up. Yeah.
and if they are rising because, as I said earlier, companies are taking capital and putting it to productive use and creating more capital,
Hmm.
hiring more employees, paying them more, um, paying more dividends, profitability is going up. Real capital in the world is is increasing,
Hmm.
and a rising stock market simply reflects the fact that all this capital is being produced, capital is being put to productive use.
Mm.
That's really good. But if stock markets are rising because central banks take interest rates down to zero, or they print money, quantitative easing, to buy assets to drive stock prices higher, that is not reflective of more capital being produced in the economy. It's simply stock prices being distorted higher.
Yeah.
Now, this distortion of interest rates distorts the economy.
Mm.
And in Western economies, you've seen productivity growth for decades grinding lower.
Yeah.
Once in a while, it'll pop up like in the
Correct.
90s with the dot-com boom.
Correct.
But distorting interest rates to drive stock markets higher
Yeah.
leads to less productive capital
Mm.
allocation.
Mm.
So they're distorting the price discovery mechanism, which is crucial in
Mm.
capital markets for the economy to function optimally.
Mm.
Even worse is in 2002, I believe it was, coming out of the very mild recession
Hmm.
in 2001 in the US, the Federal Reserve decided to create a wealth effect, they call it, by driving housing prices higher. And the idea is if people see their house price going higher, then they will extract equity from their home. They'll borrow more on their home and they will go out and spend it.
Correct.
And consumption spending contributes to GDP. All GDP is a measure of final spending within the
Yeah.
economy,
Yeah.
two-thirds of it of which is consumption.
Mm.
And so if you're a policymaker, you want to see GDP going higher.
Mm,
And so if the central bank takes interest rates down to 1% so people can afford bigger and bigger homes and drive those prices higher,
mm,
they'll spend more and they'll think it's good for the economy. It's not, right? But the end result of this is that the house prices then get so high that the next generation can't afford to buy one.
absolutely.
And the example I give in my book is our house here in the suburb. We're in Mississauga, which is a
Mm,
suburb of Toronto.
yeah.
And we bought this house in 2001.
Hmm.
And if we sold it today, we would get four times what we
Wow.
paid for it. Now, inflation adjusted, it would be two and a half times.
Hmm.
But as I was saying earlier, when you made a bike and I made a suit, and then we fairly exchanged the capital that we both produced,
Mm,
right? Not at the expense of anybody else.
correct.
When our house goes up four times in value, what was our contribution to society?
Mm,
What capital did we produce to
absolutely.
warrant making four times on our home?
Mm,
Zero. We didn't do anything. So if we're getting four times what we paid
mm,
without having to do anything for it,
mm,
then it comes at somebody else's expense.
right.
It's not something for nothing.
Mm,
It's something at somebody else's expense. So when you look at it from a societal perspective, you're
mm,
looking down. When we sell our home for four times what we paid for it, there's not four times the amount of capital that was produced. It's the
mm.
same capital as one house.
Yep.
The only difference is you see capital shift from a younger couple's bank account into our bank account.
Mm,
So it's a redistribution of wealth within society
yeah.
when central banks drive housing prices higher. And
Mm.
it comes at the expense primarily of the next generation and newcomers to our country who have to pay four times what we paid for the same economic good.
Absolutely. And I completely agree with your hypothesis on how real estate prices can impact economies. But you also write about an impending explosion or implosion.
Hmm.
What does each scenario look like, and how close do you think we are to either?
Well, it's impossible to know the answer to both of those
Yeah,
questions.
yeah.
Um, and just, for your audience, what I mean by that in the book, the path that we are on, not only is it unfair, but it's not sustainable.
Mm,
And people just can't afford to live in a society. Like, you have a choice about whether or not you want to invest in the stock market or whether you want to start a business, take a chance with your own capital. But you don't have a chance with respect to having to live somewhere. You have to live somewhere,
correct.
right? And policymakers are making it prohibitively expensive just to live. Even rents have gone up through the roof. And so it's not sustainable. And you can see that people are getting angry.
Mm,
And this, I believe, I mean, there are other causes as well, but I think this is one of the main causes of the divisiveness that we see in the world,
mm,
and I think the reason is because people can see that they're not benefiting from this system. They can see that they are just as well or better educated than their parents, work just as hard, but can't afford nearly the lifestyle that their
yeah,
parents could.
yeah.
And so they get angry. Now, they know that it's not fair, but they don't understand why. It's hard to connect the dots between central bank actions of driving asset prices higher and inflation and stuff like
Mm,
that with why I'm struggling. And if you don't understand why, you look for somebody to blame.
correct.
And so then it's very easy for Republicans to blame Democrats and Democrats to blame Republicans. Or in Canada here, it's conservatives blaming liberals and vice versa.
Mm,
That's an easy target.
yeah.
And then that will bring forward the leaders who will foment that. And and then there's calls for more socialism. And I totally understand why people think socialism would be better than the system that we have today. It
Mm,
won't be. It'd be far worse. But you understand the emotions.
mm,
And if we go down that route or some other sort of social upheaval, it would be really bad for the economy,
Yeah.
really bad for people. In the short
Mm.
term, it might look good, but longer term, it'd be really bad.
Mm.
And so that would be, in my mind, like an explosion, out of control.
Yeah.
We don't know what's going to happen.
Yeah.
Um, an implosion, just my, description, would be where rather than just keep going on this path and where some are benefiting at the expense of others and let the whole thing blow up, why don't we fix it ourselves?
Mm.
Now, fixing it ourselves will not be pretty. It will be painful for a lot of people
Mhm.
because a lot of people have benefited from this system. And again, all with good intentions. Nobody broke the rules. We all, we all just did our thing, thinking that, well, this is okay.
Mhm.
And so, and I outline half the 10 steps in my book
Mm.
about what I believe would lead to a least painful solution
Yeah.
to what we have. So, but exactly what each one would look like when an explosion would happen. It could be next year. It might be 15 years.
Correct.
And being a professional investor, I learned over the years that you can be pretty confident about when something would happen, and either it just never happens or it happens way after you thought it would.
Absolutely. Absolutely. And that's something so right. I mean, nobody can really time the market, if I can use that term. Otherwise, we'd all be sitting as very, very wealthy individuals. But Paul, I have time for
Exactly.
two more questions for you.
Sure. hmm
Were there any surprising or counterintuitive insights that you discovered during your research for your book?
Um, I don't think I discovered anything, to be honest with you.
Okay.
Um, I'm not a trained economist, and I should caution people
Hmm.
with respect to that. I was a professional investor, but I've been studying economics
Mm.
for the last probably 17 years. That's all I read.
Mm.
And and I have my own biases, of course.
Mm.
But as I say in the book, you know, uh, it's not that I've discovered anything new.
Mm.
It's more a rearrangement um, of things that a lot of other brilliant economists have put forth or discovered
Yeah.
over the years,
Yeah.
and and even economists from 150, 200 years ago. These laws of economics have not changed,
Correct.
but they've been forgotten or either deliberately ignored
Mm.
because they're not convenient.
Correct.
And when people don't like certain economic laws, they try to change them.
Mm.
And it's called normative economics, where you put forth economic doctrine not based on true economic laws, but based on your ideology, how you wish things would like to be. And
Yeah.
some economists have used the example of, doing this is like blaming gravity for plane crashes.
Mm.
No, you can't. Gravity there's a law of gravity. You cannot change it.
Absolutely.
And so, you know, what I hope, again, not a discovery or something new, is really just to help people with their understanding. I've been on a journey since I was 22
Hmm.
of intellectual honesty.
Yeah.
And don't kid myself. You know, my wife calls me Mr. Splash of Cold Water in the face. Like
Hmm.
I just I don't want to kid myself. I want to make sure that whatever I have is a result of something that I've done. And so with that background, I just want to bring more people along because I have great faith in people. I think people are so smart, particularly with their own capital and what to do with their own capital.
Mm.
They don't need policymakers to tell them how much they should spend or what price they should pay. They know. And so by empowering people with knowledge, with truth, with how things really work, that
Mm.
there is no such thing as a free lunch,
Yeah.
that these great and smart people, citizens, will demand better actions from our policymakers. And our
Yeah,
policymakers are good people. They want to do the right thing, but they won't do it unless we demand it from them. And for
absolutely.
the last 30, 40 years, we've been demanding something else. And
Correct.
so they have accommodated us. And so that's the goal of the book and
And that has
what
to
I'm trying to
change.
change.
Absolutely. And my last question for you, Paul. At the end of your book, you offer some steps for change. Could you share a few of these actionable recommendations with my viewers and listeners?
Yes, yeah, sure. So I think the first one I listed was to stop distorting interest rates
Mm,
below their natural rate.
yep.
Um, without going into detail, policymakers focus on a neutral rate, which is a very different thing than a natural rate.
Mm,
Natural rate of interest results in most efficient allocation of capital, as we discussed earlier. A neutral rate is lower than that. It's the rate that supports debt-fueled consumption without causing too much inflation.
mm,
And because more and more debt is being taken on to support consumption, that neutral rate keeps going down because the amount of debt outstanding keeps growing. Consumers and businesses or countries need a lower and lower interest rate
mm.
to service that amount of debt. That's why the neutral rate has been going.
Yeah.
But the lower the neutral rate goes, the further it goes from the optimal rate that results in the most efficient economy.
Mm,
So stop distorting interest rates. Second would be to stop increasing the money supply
mm.
at a rapid rate.
Yeah.
Now, Milton Friedman used to say it should be almost automatic, 3 to 5% or something like that. Others say it shouldn't increase at all. I
Mm,
don't know which would be optimal. I lean towards zero. But stop increasing the money supply
mm.
because it extracts capital from the rest of the money already in existence.
Yeah.
It debases the currency, it debases your wages, debases your savings. Honest, hard money. People need to trust the money and they need to
Correct.
trust the system. And then I guess the last thing I would say is that central banks need to stop bailing out
Yeah.
bad investment decisions.
Mm,
Stop bailing out Wall Street. They'll always have these excuses where, well, if we don't bail out Wall Street, it will result in a global financial Armageddon type situation. This is a false dichotomy.
yeah.
It serves both of them to get politicians and others to believe this.
Mm,
And so if you just those three steps alone, stop tinkering with interest rates, stop exploding the money supply higher, get rid of the Fed put, as they call it, stop bailing out Wall Street, deal with moral hazard. That would take you a long way to fixing what's wrong with the monetary system and lead
mm,
to a much greater productive economy and a fairer system where people only benefit by benefiting somebody else.
mm. Wow. And on that note, Paul, I just want to say what an amazing conversation this has been. You
Thank
very modestly said you're not an economist, but I think my conversation with you is an amazing economics 101 for a
you.
lot
Thank you.
of people who are listening to everything that you have said about different aspects of the economy. And coupled with your economics insights, you also have financial insights. That combined has given some really amazing thoughts to me and to my viewers and listeners in our conversation. Thank you for speaking to me and good luck to you.
Well, thank you very much, Ashutosh. It's been a real pleasure.
Thank you. Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.